Hello, everyone. Welcome to the March episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us. Coming up on today's program, stock market risk concentrated in a handful of huge mega cap companies has some investors very concerned. We'll tell you about a new ETF that aims to dampen this effect. Also, we'll break down an actively managed bond ETF that helps fixed income investors balance risk and yield. And we're taking a closer look at a pair of buffered ETFs built to hedge against stock market declines. But first, as always, we kick things off at the New York Stock Exchange. We've got Douglas Yones, head of ETFs from the NYSE. Douglas, always a pleasure to see you.
Hi, Stephanie. It's great to be back.
Let's start with the latest update on ETF launch activity. How's everything looking?
Yeah, February really stuck to the busy plan here at the New York Stock Exchange. 33 ETFs launched last month, and they raised about $408 million in new assets under management. The industry total right now, who's counting? We are 3,420 ETFs with over $8.5 trillion now invested in ETFs in the U.S.
It really is incredible. The latest global ETF survey at ETF Central covered a lot of ground. One stat that jumped out was the active share of total equity flows flooding into active ETFs. That's looking extremely robust. Do you expect this trend to continue?
Yeah, good. Thanks for catching us, Stephanie. The latest global survey just came out. It dropped. It is free. That's right, free. You can get it at etfcentral.com. Last year, 21.5% of all cash flow, that's more than $1 in $5 that entered the ETF industry. Guess where it went? Active ETFs. And that story, that active story continues into 2024. 71% of all launches this year have been active, bringing in almost $2 billion in cash flow. About a third of all cash flow this year is in active ETFs. Now, what are we doing? We're doing our job together at First Look, and we're bringing those active managers, the industry best, we're bringing them directly to you, to this TV show. So stay tuned in to this episode and upcoming episodes. We're going to have them all right here.
Yeah, thank you. We also have some great guests on tap for this episode, as you said, coming up. But before we let you go, what other ETF trends are you watching?
Yeah, we're watching a few. First of all, that mutual fund to ETF conversion trend, we've been talking about it from time to time on the show. That's off to a good start this year. 3 ETFs already converted, $600 million in assets, and we have a significant pipeline expected. So probably a strong year for conversions 2024. Also, the latest and greatest, we kicked off the CE Credit webinar series available through etfcentral.com. And if you have a certified ETF advisor designation, the CETF through FINRA, you can now get CE credits through a free webinar series, all available at etfcentral.com. So if you're not caught up yet, please go there and catch up, as well as follow the latest podcast series. You can find it all there at etfcentral.com.
Yeah, absolutely. So many great things happening over there at the NYSE in the world of ETFs. Douglas Yones, thank you so much. Keep up the good work. We'll see you soon.
Thanks, Stephanie.
And just a quick reminder that besides YouTube, you can also watch First Look ETF on Apple TV, Amazon Fire, and Roku. We also simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms. So be sure to check us out. Advancing stock prices have some investors worried because the run-up is being dominated by a handful of large mega-cap stocks. So how can investors and financial advisors dampen some of this risk while still staying invested? Here to explain is Samuel Lau, portfolio manager at DoubleLine. Hi, Samuel. It's so great to have you with us here on First Look ETF.
Hey, Stephanie. Happy to be here, and thanks for having me.
So DoubleLine recently added 2 funds to its ETF lineup, among them the DoubleLine Fortune 500 Equal Weight ETF, and that ticker is DFVE. Let's start with that. How does it work and what makes it unique?
Yeah, so again, thanks for having me here, but we are certainly excited by this launch of these 2 new ETFs that we have and bringing our total suite of DoubleLine ETF products to over $1 billion now in assets. But starting with DFVE, as you said for the ticker, we affectionately here at DoubleLine call it D5, but that stands for the long name of DoubleLine Fortune 500 Equal Weight ETF. And what it really is a unique U.S. equity strategy where we look to track the Barclays Fortune 500 Equal Weight Index, which has shown compelling outperformance relative to its large cap peers in the equal weight space. And as the name suggests, the composition of the ETF draws from the Fortune 500 list, which is perhaps lesser known to individuals in the market, but the Fortune 500 list itself is made up of the 500 largest U.S. corporations based on their total revenue generation, looking back over the past year or so, or last fiscal year. And this differs from some of the indices that you mentioned that are more tended to be based on market capitalization. But here with the Fortune 500 list, there's certain exclusions that are applied, such as the companies have to be publicly traded on the NYSE or the NASDAQ, and they also have to meet certain minimum liquidity requirements in order to be eligible for the ETF. And on average, this shakes out to about 450 names, over time, and with an average of about 120 names that, importantly, aren't typically included in the S&P 500. And in addition to that, I think another distinguishing characteristic of D5 is the fact that the exposures here are going to be equally weighted, and that provides a more balanced and diversified exposure than market cap weighted indices. Equal weighting certainly has the potential to capture the growth of some of these relatively smaller capitalized names, and this is particularly interesting, as you mentioned at the outset, Stephanie, in today's market environment where the vast majority of this recent performance that we've seen over the past year or so has really been driven by the heavy weighting in the so-called mega cap, or as people affectionately call it today, the Magnificent Seven type of market capitalization names. So it's really through this combination of focusing on revenue generation, selecting the companies that have the highest revenue generation in the U.S., and then equal weighting these underlying names is where we expect to generate our potential alpha over other offerings out there today. And I would like to just kind of end up on this by saying that the index that the fund tracks has had over 100 basis points of annualized outperformance over the S&P 500 equal weight index, with a higher absolute and, of course, a risk-adjusted return since going live back around 6 years ago for the index.
So that's impressive. Your other newly launched fund is the DoubleLine Commodity Strategy ETF, and that ticker is DCMT. Now, this fund invests in commodities using an actively managed approach. It's very hands-on. Tell us more about this.
Yeah, so DCMT, this represents our first commodity offering in the ETF vehicle, but I do think it's important to note that DoubleLine has been managing active commodity strategies for well over a decade now. So with that, DCMT being our first foray, what sets it apart is that it provides enhanced long-only exposure to a diversified basket of commodities across the major sectors of the commodity market. So, as market participants, we think about that as energy, industrial and precious metals, agriculture, and also livestock. And here for DCMT, our universe really consists of all the 24 commodities that underlie the benchmark, which is the Bloomberg Commodity Index, which is overall what we're looking to outperform here. And the approach that we take in DCMT, it's largely going to be guided by an index called the Barclays Backwardation Tilt Multi-Sector Index. And here we utilize this idea that you can look to both market and fundamental signals to help inform decisions in terms of trying to improve allocation through two potential alpha sources. So it goes away from a production weighted type of weighting mechanism that's used in the Bloomberg Commodity Index, and takes a look at these areas that potentially we can generate some excess return. And the first of which is to look at the actual weights of the individual commodities themselves and tilt our exposure to those 10 commodities that exhibit what's known as positive row yield. So we're effectively looking to tilt the overall exposures to those commodities that have the highest positive row yield. And that's overall, just in layman's terms, that's a condition that tends to be accretive to overall commodity performance and total return. And then the second potential source of alpha that we have through DCMT over the BCOM is through the actual contract selection for each one of those 24 commodities based on the futures curve. And that's ultimately based on these well-known factors today in the commodity markets that are carry, roll yield, seasonality, and momentum. And here I'd like to note that, again, we take some guidance from this Barclays index. And when you look at that index going back to its live date back in 2011, it's had a very meaningful outperformance of relative to the Bloomberg commodity index, again, on an absolute and risk adjusted basis. And then I guess finally on this final note to wrap it up, DCMT, as a lot of investors care about, it's a no K1 ETF. It's so effectively it's a 1099 fund.
Interesting. Okay, really quickly, those are two very different ETFs with very different focuses. What type of investors might DoubleLine's latest ETFs appeal to? Like, who are you targeting these ETFs toward?
Yeah. So I think given the ETF structure itself, it's a very efficient vehicle. So I think there should be a broad-based appeal to both the general wealth management community as well as individual investors alike. And I think a part of that is because DoubleLine is well known for bringing these differentiated strategies to the market. So when you think about DeFi, DFVE, I think the potential appeal there is for those who are looking for this unique way to access the U.S. equity market. One that's based on revenue generation, a la the Fortune 500, versus just a capitalization-based measure. And then also, again, given where we are in the market, equal weight methodologies should appeal to those who think that this run-up in the largest capitalized names, those magnificent sevens, the mega cap names, that might be starting to get a little bit stretched, both in terms of valuation as well as weighting within the market cap weighted indices. And then finally, for DCMT, I think something like that should appeal to allocators looking for a better approach to obtain long-only commodity exposure. As overall, when you think about commodities being a strategic position in the investors in portfolio, it has the characteristics of being able to provide a diversification to traditional assets like your equities and your fixed income. It can offer inflation protection, and of course, you have the potential for incremental returns there.
All right. A lot going on with you guys. Thank you so much, Samuel. It is great to have you with us.
Thanks, Stephanie.
One of the challenges investors face is staying fully invested while simultaneously limiting stock market risk. A newer ETF category of funds gaining assets is known as buffered ETFs. Now, these buffered ETFs are designed to help investors to manage risk and return. Here to explain more about it is Johan, head of ETFs with Allianz Investment Management. Hello, Johan. Thanks for joining us here on First Look ETF.
Yes, absolutely. It's good to see you, Stephanie.
Okay, we're going to start with buffered ETFs. For those who may not be familiar, what are buffered ETFs and how do they work?
Yeah, I appreciate the question. It's still relatively new and a lot of advisors and investors still don't know about this category or haven't heard about buffered ETFs. In a simple way, this is for investors that are willing to give up some returns that they don't necessarily need, as long as they can protect against losses that they can't afford at the same time. So a lot of these investors, they're right pre-retirees and retirees that tend to gravitate towards this type of investing. Practically speaking, these ETFs give you upside participation to the S&P 500, and it goes upside participation up to a cap. And then in return for giving away those returns that you may not need, you get a buffer underneath of your portfolio that will absorb any losses that go down to the tune of either 10 or 20% in the case of our ETFs. So a simple example, if you're invested in a 10% buffer that has an outcome period of 1 year and the market is down by 10% or less, you're still flat. You didn't lose any money over that period. So if you put $1 million in, you still have $1 million at the end of the outcome period, net of any gross of any fees. So that's at a high level how they work.
Allianz recently added 2 new buffered ETFs to your lineup. Those ticker symbols are FLJJ and 6F, that's SIXF. Can you compare the differences of these 2 products and explain how they work?
Yeah, sure. So 6F is a 10% buffer on the S&P 500 over a 6-month outcome period. So instead of having the outcome period lasting for 12 months, it's now cut in half. So effectively, what that means is that you have an opportunity to reset the cap and the buffer every 6 months instead of every 12 months. And that comes with a few different benefits that we can chat a little bit more about. The floor is almost the reverse of the buffer, where you have a hard floor at -5%. So if the market is down, you can never lose more than 5. So if in the case of a buffer, if the market is down by 11%, in the case of a 10% buffer, you lose 1. If the market is down by 12%, you lose 2, and so on and so forth. In the case of the floor, if the market is down 2, 3, 4, 5%, you lose those up down to 5%. But if the market is down by 6, 7, 8, 9, 10, 30, 40%, you still only lose 5. So you're maxing, in other words, you cannot lose any more than 5% over a 6-month period.
That sounds very attractive. How do you see buffered ETFs then, like FLJJ and 6F, being deployed by investors and financial advisors?
Yeah, so we see it's actually across the board, and a lot of this comes down to how you're managing your portfolios and portfolio construction. A lot of times we see this as a way to de-risk an equity allocation as an investor becomes more conservative, as they go from aggressive to conservative. But we also see a lot of advisors taking a piece of their fixed income allocation and putting it into a 20% buffer, for example. So it gives you access to the equity risk premium, but you still have a nice big cushion underneath of you should markets turn south. It's also really attractive as an alternative. It comes with some really cool correlation benefits. If you think about this, you have positive correlation to the equity market when it's going up. And then when the market's coming back down, that correlation starts moving closer and closer to 0. So when you don't want diversification in your portfolio, you don't have it when the market's going up. But then when the market's turning, that's when you actually get the benefit of closer to 0 correlation to the market. You can also use these to motivate cash to get off the sideline. It feels a little bit safer to jump into an ETF that gives you a nice cushion underneath without going all the way into pure equity exposure. And we also see a lot of tactical positioning in these funds. So you can trade them intra-period, opportunistically as well.
Yeah, and that is a really good point about, kind of propelling people to get off the sidelines or get out of cash and dip their toe back into the market. So that was a really good point. All right, Johan, thank you so much for stopping by today, sharing more about your ETF and your company. It's great to have you with us.
Yeah, thank you so much.
Okay, the bond market has been dramatically reshaped over the past few years. Behind the shift has been aggressive rate hikes by the Federal Reserve. So what are some of the challenges now facing fixed income investors? Well, here to discuss that, along with a newly launched, actively managed bond ETF, is Brandon Clark, Director ETF Business at Federated Hermes. Hi, Brandon. Good to have you with us.
Hi, Stephanie. Thanks for having me.
Okay, before we dive into your new bond ETF, we've seen many dramatic changes in interest rates and the fixed income market over the past year or so. What are some of the challenges that bond investors are now facing?
Yeah, I think, we saw over the last 2 years a lot of challenges for investors in fixed income, starting in the beginning of 2022 when we saw the Fed raising rates aggressively. Unfortunately for bond investors, 2022 is not a great period for total return for most investors. Now, I think we've seen during that time period over the last 2 years, we saw a lot of money move into money markets. Federated Hermes being a big money market manager, we benefited from that. But I think now the challenge that investors are starting to grapple with is, we think the Fed is done. The question becomes, when do you move? Right? There's a lot of conversation around extending duration. When do you get out of cash or money market-like instruments? I think the challenge there is always, it's really hard to time the markets. So when you have a really hard time timing the markets, it's almost, it's a bit of paralysis.
Yeah, for sure. The Federated Hermes Total Return Bond ETF, the ticker there is FTRB. This is an actively managed fund, which of course gives it the flexibility to invest across different sectors within the bond market. What does the fund hold, and how might it help solve the challenges that are facing some bond investors?
Yeah, so FTRB is as you mentioned, a new fund that we just launched about a month ago. I kind of look at it as it's our full expression of our investment expertise. So it holds, think of it as an aggregate type portfolio, but it's a core plus. So it holds high yield, bank loan, emerging markets. So it's really kind of a composite of all the different fixed income asset classes that are available to investors. And really, when you think about it from the standpoint of it's an all-in-one, right? It's a one-stop shop for investors. They're looking to us to utilize our expertise as to what's going on in the bond market, as to where to be best allocated. So again, given a lot of the challenges that we've seen over the last 2 years, investors not quite sure where to move, where the opportunities are. FTRB really gives investors an opportunity to just allocate to one place and let us use our expertise and what we're watching day to day in fixed income markets, how to best allocate the fund.
So then how do you see a bond ETF like FTRB being used by investors and financial advisors inside of their overall diversified portfolio?
Yeah, again, I think this almost becomes that one-stop shop for a lot of investors who, given what we've seen over the last 2 years, there's a lot of challenges in trying to pick your opportunities, your right spot, when to enter certain markets. FTRB can almost be a way to outsource some of the investment process that advisors might have historically been doing through either, I'll say, the building block approach of using various fixed income portfolios or products to build a portfolio, to almost saying, let me utilize your expertise. Let me use your way of investing in order to get the best exposure given the period of time that we're in.
Yeah, and that makes sense. You know what? You guys are the experts. So there you go. Brandon, thank you so much. It is so great to have you with us here on First Look ETF. Thanks for sharing more about FTRB.
Thank you, Stephanie, for having me.
And that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. We want to give a big thanks to all of our guests, along with Douglas Yones from the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.